I moved from Canada to America and I was going to buy a place and do an Airbnb. And Airbnb was just kind of starting out. And, you know, I said, man, $300,000 for this place. I don't know if I can afford it. The same place is worth $900,000.
Wow.
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome to the Capital Raising Show. I'm your host, Tim Mai. Today, I have Trevor Thompson on the line with us. Trevor has a very interesting story, and he is known in the community. He's the only one probably that's known in the community as a professional passive investor. He has invested 16 deals as a LP, as a passive investor, and 3 deals as a GP, as an active syndicator. Yeah, he's also done a lot of different types of deals, everything from multifamily to retail strip malls to townhome to condo conversion to ground up multifamily to medical office building, land development. Just a host of variety of different asset classes and different stages of the class from ground up to already existing. So I'm really looking forward to interviewing Trevor today to kind of get behind his mindset and his experience on what he likes, what type of assets he likes, why he goes into so many different asset types, and super looking forward to this. A professional LP, professional passive investor. Welcome, Trevor.
Makes me sound like I'm extra smart if I'm a professional, but I've definitely done a lot, and I've definitely done a lot of research, and of course been in such a variety of deals. So
yeah, I love that about you for sure. So let's why don't we start out with if you can share with everybody a little bit about your journey on how did you get started in real estate investing? What got you even interested in this?
Yeah, so just a quick brief story. I'm originally from Canada. Been in the attraction and entertainment business most of my life. My last career was with iFLY Indoor Skydiving.
Oh, wow.
I did 20 years with that company. Loved it. And actually, the very first team meeting, the owner gave everybody a copy of Rich Dad, Poor Dad. And I read the book and went, wow, this is amazing. I got to think more about this. And then I did exactly what everyone else does. I got busy with my life and I just kept working my job and not paying any attention to becoming, somewhat having a second passive income, doing different things. And then we got bought out by a private equity company. So I actually got a payday. And I thought, okay,
wow, nice.
No excuse now. So, but I hadn't really done any homework. So I started doing I call them the weekend warrior guys, right? Like they come to town and you join their seminar and you pay $50,000 and we'll teach you how to buy an office building with a credit card with no money down. And I'm like, something about this doesn't sound right. And I went to a few different ones. And then I did find one. And what I liked about them is they were based in Texas. They invested in Texas. They had monthly meetings so I could go meet the people. I could connect. So I joined that group. And did my first few investments with that group. And, clearly I learned a lot doing it that way, but, their training was a little basic. They were really good at single family and decided to get into the commercial space, mostly just because they had a lot of people in their program that wanted to invest their 401k money and their IRA money. And so they thought, well, if we create these syndications, it will be good. But since then, I've done a lot more self-education. I've joined other mentoring programs just to sort of fulfill my knowledge base. But I'm one of these people that I'm obsessive about things. So once I start learning, I love learning. I love going to meetups and I love connecting with people and doing things. So I just kept learning and learning and learning more about the space.
That's awesome. Wow. And when was this that you started?
I started 5 years ago. So 2000, I guess that would be, 2018.
That's awesome. Okay. And so you started out investing into these deals that was in the group, correct?
Yeah, that's correct. Yeah. I did my first 2 investments with the group very quickly. to be honest, I was not educated.
Were they big? Were
you
they
know,
big deals, small deals? Like what size deals were
one
they?
was small, 58 doors, and the other one was a bit bigger at 176 doors.
I see.
But I invested in both of them pretty quickly. And I'll be honest, I read the PPM, but I didn't really know what I was reading. I didn't know what I know now, of course, because I've
Hmm.
invested in a lot of deals and learned different things. And there were definitely, in hindsight, some things I should have noticed about the deals. So one of them, everybody knows if you're going to buy anything in Texas, insurance and taxes are going to go up significantly. So the
Hmm.
one deal, both things went up significantly, and it just ate all the cash flow.
Oh
And they
wow.
managed to sell, and we got our money back. It was one basically, we got in, we got out. It was pretty quick. They got an offer that got everybody out with just their money back, and we all considered we dodged a bullet. And then the other one was a little bit different, that they just didn't have enough money in their CapEx budget. They'd underestimated how hard it was to reposition a property. And that one I even volunteered as an asset manager for 10 months. I had some extra time on my schedule, the way my work schedule was. So I said, hey, listen, I'm not learning anything. This is supposed to be a mentoring program. Could I help out? And so they said, yeah, you could help us with this. And you'll learn a lot and do that. It was kind of an interesting story. I did a whole other podcast on it. It started out, I was going to help an asset manager, and then I found out all kinds of things, because I'm going to go there and do my due diligence, right? So I did a rent roll audit, I did a bunch of things, and I found out what he was telling the owner were not the correct facts. I mean, there were people that had skipped apartments for 3 months, and they were still showing them as occupied. And they were telling them we were 92% occupied, but our economic was actually 82. And so
Wow.
I called the GP up and said, hey, do you want the truth? And he went, of course I want the truth. And so I told him the truth. So 2 days later, I wasn't helping an asset manager. He was gone. And then about 6 weeks later, they decided to fire the property manager. So here I found myself part-time, still with a full-time job, managing a deep value add apartment in San Antonio. And then, of course, COVID came, and it just became super challenging. We managed to stabilize the property. We had some disagreements about what we were going to do once we put it up for sale. Then the sale didn't happen. And then the decisions they made, I think, affected the business. And they, so basically they wanted to build the occupancy up. So they said to me, okay, 2 times income, and the only people you can deny are violent offenders and sex offenders. And of course, they accepted all the wrong people into the apartment complex, undid all of what we did, turning it around. It didn't sell. And then they ended up having to deal with those tenants for another 8 months, and finally sold. Everybody got their money back, but nobody made money. The GP claims he lost money, but it was just a mess.
Gotcha. But
But
so
biggest
so it
learning experience of my life. I mean, I spent
right.
10 months learning what to do, what not to do, how to understand, and when I had a question, I'd have to go find the answer because there was no support mechanism to teach me the answer. And so I would call other people. I did a lot of training on asset manager. I paid for courses when the APT Capital with Kyle and Gary, when they were together, they did a training course, and I signed up for their course. I read their book, and I went to every meetup that an asset manager spoke at, and just learned what should I really be doing here. I've never done it, so I learned a lot. So the education side of that, was priceless. And then one of the things was I got let go that year with COVID from work. And so I managed to switch my status to professional real estate status. And so I got paid a severance, but because I'd switched my status, at least I got my taxes back. So in theory, I made some money doing it. And that was when I decided, okay, I'm going to now switch to active, which isn't as easy as they say it is. So, but in between there, I've done a lot of passive investments. So I know we're going to talk more about those and why I
Right.
chose different asset classes and things.
Right, exactly. So I guess the good news on your first 2 passive investing deals is that you didn't lose any money on them. right?
That's correct.
You get your
That's
money
correct.
back. So at least that's a good news.
Yeah,
It'll
and
give
then
you a
my
good
third deal's
education.
gone full cycle, which was the apartment to condo conversion. And
Okay.
even though I did really well with the real estate prices increasing, you bought an underperforming asset, you were going to turn them into condos and sell them, and then COVID and the eviction moratorium came. So you had an underperforming asset, you couldn't evict the tenants, and then the tenants felt empowered because they were only month to month knowing they were going to get kicked anyways because they'd all been given notice. So they stopped paying. And luckily I got my money out of that. I was what's called a preferred position, no upside. So I got caught up. They didn't pay any money for 18 months during COVID, but I got caught up, got my money back, made my 11% preferred return payment. So I was happy. And, and then finally it was all done, and, everyone else made some money and got paid out. So, and that one I did I wanted to learn about that to see what it was like, but I don't think I got a good learning because I hope we don't have another COVID ever again like
Right.
that. Pandemic. And
Yeah.
so, all business conditions are thrown out the roof, right? So, because you couldn't evict the tenants. Then when you could evict the tenants, you couldn't get a building permit because the city was still slowly opening. Then you couldn't get supplies because the supply chain ran out. Then you couldn't get workers. Nothing normal happened, but I was good friends with the guy that was kind of managing the project. And so I got a lot of inside scoops about, how much more challenging and what normally should happen.
Right. Yeah. It's COVID definitely it's an interesting time for sure. So that deal made money
Yes.
itself, and all of the investors also made money, correct?
That's correct. Yes.
Okay. And so I know that was just your third deal you're sharing, but have you done more deals where you only got a prep and no upside?
Yeah, so I've only done one more like that.
Okay.
And it was in the medical center one, and the medical center was just a straight 10% return, no upside, just a pref payment. And so first of all, I thought, okay, medical's very stable. I knew the people that were doing it, and I thought it was a really good place to put my self-directed IRA money, right? I'm okay on my IRA money to take what I'm going to call the safe path, right? And so just the pref equity. And I had no idea in medical centers, but not only does the doctor's practice guarantee the lease, they have to personally guarantee the lease too. So it's like a double guarantee. So if this fails, you can still go, in theory, take his assets. So very secure investment. And, again, COVID made me much more interested in the medical space. And this is one of those offsites, with a little emergency room, a dentist, and some things. And so those things have thrived since COVID because, the big hospitals, they just couldn't maintain the number of volumes of people. So a lot of people went to satellite operations. So I think it's going to be a great asset class, and I plan to do more in it.
Okay, good.
And then the
good.
interesting story, retail, I decided I wanted to do a little retail, and really good timing. We closed March 20th, 2020. So not a good time to close out a retail store. But I'll be honest, they've managed to pay 5% cash on cash, which is nothing to write home about. But considering we weathered the pandemic, and I have a call later today for this quarter's update to see what's happening. All things considered, I consider myself very lucky, and I'm still quite interested in retail. And I don't think it's dead. I think shopping malls are dead, but I don't think strip centers are dead, right? People still going to restaurants in their neighborhood, still going, TIFF treats, going to the karate place, going to, I think those ones are still going to do quite well. Where the big box stores and the shopping centers, they're going to still struggle, I think, for quite a while. You can't change everybody's shopping habits to online and then change it back to going to a mall, right? When you got just used to pushing that Amazon button.
Right. Yep. Yeah. So that's definitely good to hear about that. And so moving forward, I mean, in terms of the deals that you're only getting a prep, you're open to that. Is that correct? So if the deal makes sense, you'd still be willing to passively invest just for the prep without the upside potential. Is that
It's
correct?
not my preferred. I've just done it on certain circumstances.
Okay,
My
okay.
preferred investment is where, it's a reasonable split, between the GP and the LP. So, I don't like deals that the first split is 60-40. I think that's too much. I'm okay 70-30, love 80-20, obviously. I'm on one deal that's 85-15. I like that one even better. Much more LP centric, but it's, in that range. And I also like to passively invest in deals that have a preferred payment. And for the people that don't know what that means, it basically means that the investors get paid first before there's, and then if there's enough cash flow to pay them the full 7%, then the general partners, the people running the deal, they also can get paid. So I think that really aligns the interest, right? Work really hard, make sure I'm getting my minimum payment so that you can get paid. I like those kind of deals. And I also don't mind a deal when they hit a threshold. So they call that a waterfall. We don't want to get too complicated and technical. I'm okay if they hit a certain waterfall that the split changes, right? That, let's keep them motivated to create,
Right.
at least, let's say, a 16 IRR, which is what I look for and above. That's what's most interesting to me is the internal rate of return. To me, that kind of balances out everything, right? At the end of the day, it's kind of the normalizer of all investments.
Right. Okay. And I mean, so I'm curious, for an operator, syndicator offering an 80-20 split or an 85-15 split, that seems pretty aggressive in the sense of like, they're not getting much for themselves, and so so does that scare you at all in terms of like, why are they offering so much to the LPs, to the passive investors, and are they a newbie? Are they...
like there was a deal that was offering a 12 craft, and I thought, man, the GP team's never going to get paid because it was a deep value add, it was a reposition, they're going to lose interest. So I completely just lost interest at the very beginning of the deal. But, to get a deal that kind of normalizes after the 5 years at about a, 7 to 10% cash on cash return, and you're getting a 7 pref. I look for a deal that can kind of normalize, right? So, I want it to be about 18 months that, the GPs will start making money, right? I want them to be able to see the light at the end of the tunnel. I certainly don't want to, I don't want them to lose interest in the deal.
Right, exactly.
And that goes back again to trying to pick, the right team, the right people to invest with, which is a whole other topic. But, it's very, very important for me to have the interest aligned. That was, I get paid first. Once I get paid my reasonable, which 7% is a reasonable, it's not like a high, it's not like 10 or 12 like the other one. And then they can start making money. And then, once we get stabilized and we get closer, they're starting to make money. And then if they achieve well, again, I'm okay if they double their money, right? If it goes, I was on one deal and it was 80-20 and it went to 60-40. So the GPs would double their money if they hit a hurdle. And to be honest, I want them to hit the hurdle and double their money, because that means I've met what they've said should be a normal return for the deal. I've exceeded what would be my normal return.
Right. That's good. Yeah, I like that. So let's I guess let's first dive into the numbers. You mentioned you like at least a 16% IRR. For those of that don't know, can you quickly explain what that means?
Yeah, so it's a very complicated explanation, IRR, but I call it the present value of your money. In other words, it takes how long has your money been out there? Have you made or lost on your money? And at the end of this particular period of time, it assigns it a percentage, right? So, that you can have these things called average rate of return, you have cash on cash. All of those numbers are important and need to be looked at depending on where you are in your life and what you need out of your investments, right? So, when I was working, I could care less about cash on cash. It was a nuisance to get the cash almost. Just give me some big money at the end, and And I always do still like the multiplier of my money, but at the end of the day, that's a false number, right? Because if you double my money in 10 years, that's a very low internal rate of return. But if you double my money in 5 years, that's
Right.
a much higher internal rate of return. So at the end of the day, to me, it's the balancing number that kind of says, okay, how long have you had my money? And over that period of time, how much have you paid me, including what payments I've been made and what I made on the profit of the sale? Kind of averages out all of everything. It's kind of like an equalizer of all the different numbers. And that's why I look at it the most. To me, it's the most important number to look at.
Okay.
You know,
Yes. Okay. So IRR is the most important for you. Is the cash like I guess at this time in your life is cash on cash
so
also
it's
like up
definitely more
there?
important now that I don't have a job. Before it wasn't important. And that's why I like to be in the 7 pref position. So if there is cash flow, at least I
Mhm.
get my payment first, right? So I will make some money.
Okay.
I'll be honest, I'm in a lot of value add deals, and just one of them finally hit a 7% payment. So listeners need to understand that a lot of value add deals, and most syndicators are fairly honest in it, right? So I'm presenting a deal soon, and you're really not going to catch up till about 18 months because it takes
Mm,
about that long to stabilize a value add property. And then it starts to normalize. And, but the thing I like about it is that if there is cash flow, I get my percentage of it first.
right. So okay. And would you say that if someone's goal is to make monthly cash flow, then they should invest in a more stable property?
That's
Uh,
correct. So
okay.
again, it's risk and reward, right? So if you want a stable cash flow, normally there's less risk, so there's less reward, right? So
Mm,
again, my medical one, it's a 10% pref. I get the same amount of my money every quarter in my bank account, all the time. I mean, unless cash flow doesn't permit. So far, cash flow is permitted, right? So
mm,
again, if there's not enough cash flow to pay the 10, it accumulates and I get caught up. But on that particular one, there's been enough cash flow that it pays it all the time, right? So again, if you put $100,000 in the deal, you're going to get just less than $1,000 a month, which is just less than 3,000 a quarter. And hey, this money is pretty consistently coming to me, and
right.
that's very important. That need this money to live, right? A lot of investors, though, do have jobs, so they don't need the money to live. And they should actually not be taking the money to live. They should actually be reinvesting, right? Because that's how they're
Mhm,
going to really grow their wealth, right? That's the
right.
compound effect is like a massive on real estate investing when you keep letting it reinvest, right? But people do need cash flow to live. It
Okay.
sometimes, so
Right. Okay.
you still got
Okay.
to eat. Eating comes first.
Yes.
Paying the bills.
Yes. Okay. So you prefer at least 16% IRR, at least 7% prep plus whether it's 70%, 80%
Yeah.
on the back end, right? And then yeah, and then cash on cash. Is there a percentage that your goal is?
I'm okay at the 7, right?
Okay.
If it's a deal with an upside. If it's a deal
Okay.
without an upside, then I think 10 is a fair number.
Okay.
So
All right.
the 10% is a fair number. If there's no upside, there are a few deals that offer 12, but they scare me, right? And when they scare me because the general partners have almost no hope of making any cash flow, right? Just because the nature of these deals do not spin off a lot of cash. The
Right.
nature of all these types of real estate investments are to improve the basic business, take the multiplier of selling it on the cap rate,
Mm-hmm.
and there's where the big return is, right? So a lot of these deals, the return is still made on the sale or on the refinance. In other words, you've refinanced it, you've taken some money out. So for example, my storage investment,
Mm-hmm.
they have a recourse loan, but once they get up business, they get it stabilized, they're going to get a new loan and give us a percentage of what we invested back, but we don't get diluted when we get our money back. It's something that's very important for investors to understand. they give you back half of your money. Do you only own half of what you used to own? And that particular one, when they double my money, goes to a 50-50 split. And I'm like, double my money, baby, double my money, because I'm okay with double my money, right? Faster the better. And for them, faster the better, because now they get significantly rewarded.
Right. Yeah, I like that.
And investors should never be afraid of a win-win, right? You want everybody to make money.
Right. So when you have an operator that offers you 12%, and you're like, ooh, I don't like the deal. You're not gonna make any money. Do you let them know that?
Yes. If I know them and they ask me, or if you send me a deal, I get some emails, 22% IRR. To be honest, I just hit the delete button.
Really?
My mom has said if it's too good to be true, it probably is, and she's been pretty good at giving me life advice, right? And I like what I'm going to call realistic presentations, like don't be really low, don't be really high. You make me nervous, right? Okay, where do I got to dig to find out how are you going to give me 22 IRR on this deal?
Right. Okay. So let's look at that. So what is the high? So on the low end, you want 16. What's the high end that you be like, that's comfortable?
Well, so I'm okay if it just, in other words, I want them to say, hey, we're projecting we're going to get 16 IRR, but if we give you better than 16, we're going to take a bigger split, and let's hope it's 18, 19, 20. I mean, I'm on a deal now. I don't even know what the IRR will, but it'd be insane. They're tripling my money in 3 years. Okay. Now that's happening just because the world's gone crazy, right? That's not normal. People shouldn't, I'm not going to expect this for my next 15 investments, but I'll take it. And it happened just because it's in an insane hot market in Tucson, Arizona. They bought it at a great price. They managed to stabilize it. They managed to get a buyer before the world went a little crazy. They have had one retrade. We're actually supposed to be 3.5, and it's gone down to 3 because they've had to retrade because of valuations and stuff have adjusted a bit. Still 3 times, that's probably going to be a 30 or 40 IRR, right?
Wow.
But it wasn't what was promised, right? It wasn't what was promised.
So,
2 years to your money.
Right. So like in terms of the emails that you're seeing when they're sending out in their marketing, at what number do you delete? Is it 20%?
So remember, first of all, I only pay attention to people I know, like, and trust.
Okay.
So once I get to know somebody, I look at their emails. To be honest, I scan down to the bottom. Always put your picture if you're going to send me a thing to invest. I look, do I know this person?
Okay.
And if I don't, I hit delete immediately. I don't know you. I got on your list somehow, but I don't know you. And then if I know you and I'm interested in looking at deals, which I'm not right now, so I'm hitting delete way more. And sometimes I attend webinar just for my own personal education, just to learn how are they presenting and doing it. And plus I like to follow certain people, which is something we'll talk about in a little bit, but actually talk about it right now. I follow people before I invest in them. I go to your webinars. I listen to your podcast. I want to know, are you only telling me the good stuff in your life, like you never have, you've never had a deal where you've struggled, and I don't want to invest with somebody that can't be truthful and say, man, I had a deal, man, and it was a bear, but this is how we got out. Investors got paid first, and all of these things. I like that honesty, and it makes me much more willing to invest in that person. So there are a few, and then I also right now invest for opportunity. So I want to get to know people. So when there's people that I've connected with and I want to get to know them, and sometimes it's like really sort of like very interesting what happens. So I invested in someone's deal who's a very well-known person in Texas. I also comment a lot on his Facebook posts, and he always says, "Thank you, partner." No idea the power that puts over to me for this person to say thank you, partner, right? I mean, I always joke, I own a doorknob on a new build. I probably own more than a doorknob. But, in perspective, right? This is the, this is the $40-50 million deal and I've got $50,000 in it, right? So maybe I own the kitchen or the bathroom more than the doorknob, but in reality, you know, I don't own a lot of the deal, but the relationship for him to be able to say, thank you, partner. And, you know, when I see him at events, he always updates me on the deal. And, you know, that's important. And, you know, and that was my first new build, right? So it's a new build in Houston area. They'll start leasing by the end of this year. And I think we're going to do very well because they managed to buy most of the materials before the world went crazy. They got the land before the world went crazy. You know, there were a lot of things.
Right. That's good. Okay. So let's assume that, you know, they are someone that you already know. Maybe they're not like a top operator where it doesn't matter what kind of IR they promise or they advertise you'll be in because you just know who they are. But let's say you know them enough to be willing to invest with them, and they advertise, you know, I'm trying to get to a number. So like, is it 20% IRR that you're like, you know what?
No,
I'm
I
gonna pass
look
on
for
this deal.
16. I want to, you know, because I think
Okay.
anything, I don't, you can make an Excel spreadsheet that says we're going to make anything, right? I don't
right.
want to work hard to disprove you. I want you to give me,
Gotcha.
like, we've got this deal. Everybody says they've been conservative, whether they're not, right?
Right.
I love it when we've been conservative. Rents are going to go from 16,600 to 1,200. You know, I don't think that's conservative, my friend, you know?
Yeah.
You can look at the income in the area and it's $36,000 and we're going to go to $1,200 rents. I mean, you're nuts, right? You know, so I look for things that make sense and reason, right? So here's the rent, here's the comps. We're going to come in a little less than the comps and be about here. And it's going to, and some people say, oh, we're going to achieve this in 6 months. Well, you can't. You can't
Right.
turn that, the leases get away from the, you know, so I want somebody who's laid out a realistic plan, right? Here's our 18 months, you know, and 18 months is a very realistic thing for a value add property, which most of my investments are to get it up to where you can stabilize it, right? Because it takes time to fix the exteriors, take care of the deferred maintenance, turn the tenant base, improve the tenant base, increase the rents, because you can't increase the rents if you, I mean, during the crazy couple of years, people were increasing rents without doing anything, but this isn't normal, right? We need to consider the world's going to go back to normal, and you know, want to make sure they have a good plan.
Okay, that's great. So what other, in terms of numbers wise, because we are going to dive deeper into the operators, the people themselves, right? But
so numbers, I look for realistic CapEx budgets. You know, so this is a deep value add and we have $4,200 a door. Well, you're not going to do it.
Yeah.
You know, or do you have $8,000 a door, or do you have $12,000 a door? Again, I like to look at the quality of property. Are they over renovating, under renovating? You know, do they have realistic numbers, right? You know, I went to one webinar and they were like, they had $50,000 in their exterior CapEx budget. And I'm like, you can't fix anything for $50,000 on a 100-unit building. You got no money. And so what happens when you have no money? You take it out of cash flow. Well, who does the cash flow belong to? Me as an investor, right? So raise enough money to do the deal right, have realistic numbers. So CapEx numbers, you know, I went to a webinar and they said we were going to add preferred parking. This was a series of fourplexes with 4 parking spaces in front. How are you going to make, like, how are you, it's like there's only 4 spaces in front of a fourplex. How are you going to charge somebody to park in the only 4 spaces next to their unit? You know, so if you were going to say we were going to put covered parking, okay, that's a whole different story. But, you know, they literally said we're going to have preferred parking. And I Googled Earth the property and I'm like, this is 4plexes with 4 parking spaces. You know, so verifying things like that are correct. Verifying that rent bumps are correct, right? Like, so just doing some simple math, right? What is the, you can find the income of the neighborhood very easily on, you know, on a Google search. And, you know, you don't want it to be anywhere near, you want it to be, you know, you want people to make 3 times kind of deal. You want to make sure you've got that metric in there, right? So, hey, rents are $750 and we're going to $1,000. but the neighborhood could only afford 800. Nobody's moving from the nicer neighborhood to the worser neighborhood to pay more rent at your place, no matter what you do, right? So so I look for those things to be realistic, right? And rent bumps to be realistic. And then I love that, we're in an inflation of 9% and their expenses are going up 2% per year.
Mhm.
Well, how in the world are you living in a 9% world? You're putting your rents up 12%, but you're only putting your expenses up 2%.
Gotcha.
A lot of deals like that because, that's what they got used to putting in there. Then they got, we got these big rents before we had inflation, right? Well, now we have inflation. And so maybe you could put 5 and say, we're really going to watch the money and be very careful. And, we think we can do a better job. Okay, I might buy that. That's
Mhm.
okay. But 2%, it just isn't enough. So I look at, is their whole plan realistic, right? And I'm
Right.
not like an underwriter guru. I'm a gut feel guy. Are your explanations reasonable? And that was what I didn't know when I first bought my first deal that made no money, right? They were a deep value add. They told us it was a C+ property. It was a D+ property.
I see.
And, they had $4,200 a door in CapEx, and they needed like $8,200 a door in CapEx. And if I'd have known that now, I never would have invested.
Gotcha. Okay. And so now let's talk about the people. How, you had mentioned some of it where you follow them, you get on the podcast, you want to see people who are authentic, who actually shares their struggle and not all good. So some of those things, what else do you look for in, especially when you've never invested with them before? What else do you look for?
So I look for people that know them and ask them, like they'll tell you the people that are going to say nice things about them, right? So I try to find the people that aren't going to say nice things about them, or at least going to say the truth about them.
Oh, that's good.
So
I like that.
You can usually dig around and find out, and when people make comments, hey, did you invest in this deal? Would you mind taking some time just to talk with me? I'm thinking of investing with that person. So I've done a lot of that way, right? So because people post, hey, we just bought a property, we just sold the property, we did amazing. I'd like to talk to the investors and just get a little general idea, and then I ask other sponsors about them, especially when I see they were partners and now they're not. Well, that's always fun. You can get them to actually talk to you because the reason they're not partners now is there was some sort of unalignment of values or they just, why didn't you connect with that person? Why, and I'd love to see them do 10 deals together, right? That makes me feel good. And when partners struggle, a deal often struggles.
Gotcha. Okay. So if, let's say somebody you talk to, they've lost money on a deal with that operator. However, let's say it was 5 years ago, and that operator seems to be doing pretty well now. Would you consider investing in that operator's current deals?
So I would, if the person I was talking to, said, man, they communicated with us, they really tried, we had some real serious issues, and they were honest with us through the whole thing, and instead of doing a cash call, they put their own money up, and things like that. So I've heard stories of operators, one operator they were also in charge of the CapEx for the company they own, and they just kept spending money through the pandemic and then did a cash call. So I'd never invest with somebody that did something like that, right? Like, they made about $300,000 in construction management fees.
I see.
And then did a cash call. Now I'd be better to say, listen, man, I screwed up. I probably shouldn't have kept investing. I'm not taking my payment till we close on the deal, so we don't have to do a cash flow. That to me isn't acceptable, right? Okay, I misjudged. I thought COVID was going to last for Who thought COVID was going to last till now?
I know.
I got like 6 people out with COVID right now that I'm talking to, and it's like, so whoever would have thought, right, man, I misjudged this, right? and so I'm going to personally take care of it, then that's a good story. Even though maybe what they did wasn't all that smart, they understood it, and they took the heat and made the correction.
That's awesome. And can you, for those that don't know, what is a cash call?
Cash call is when they say to the investors, we ran out of money and you need to put more money in. And if you don't put more money in, your share of ownership will be diluted. And it'll be all listed in the PPM what the rules are of a cash call, right?
Mhm.
So it's often listed, because again, if a project runs out of money, they go back to the investors and say, we ran out of money, we need more money. And you are obligated to pay that money. And if you can't pay that money, your shares will be diluted.
Gotcha. Okay. What else? What else do you look for in an operator? Especially a new one that you're considering in investing in.
So again, do they think the same things I think? Are the things that I think important to them? Are we connected to the same groups of people? I want to invest in people that I think that my values are aligned, right? I want to invest with people that I think they're trying to work really well with their property management company, and they're trying to be good business people versus always screaming and hollering at the property manager, putting unrealistic expectations. I'm involved with somebody that's gone through 5 property managers in 3 years. Well,
Wow.
There's a problem. There can't be 5 bad property managers, right? That's a bad owner, and it's just what it is, right? And people that are difficult to deal with. And people, how they answer things to me are, I invested in a deal and I asked it what I thought was a very simple question. How are we doing year one compared to year one's pro forma? And the answer was, you can look it up in the PPM. Well, that's not a good answer. You should be saying, here's what we projected, here's where we are, here's the difference, here's why. That's what a good operator tells you. Even if it's bad news, here's the why, and here's where we misunderstood. I want, again, honesty.
I see. That's good. And do you prefer an operator who is vertically integrated, and so now they have in-house property management, in-house construction? Do you prefer that at all, or depends?
Not necessarily, no. I think managing yourself, there can be great things and there can be great inefficiencies, right? And if things get, if every layer is you, then you're only as good as you, right? Even if you hire great people, the people you hire are only as great as the person who hired them, right? Push them to the next level. So I kind of like the mix of someone else coming in and some fresh ideas, especially property management companies that manage thousands of doors. They've got a wide range of experience, and they may have a solution that they thought somebody, and again, if they're a good property management company and they're listening to their managers, some manager way over here could have come up with a solution that's perfect for my property that I never would have known because I don't know this manager. So I definitely think there's advantages in it. And I like that variety. It's almost like a check and balance.
Right. Okay. And then kind of circling back again with the numbers, but looking at the interest rate and projecting out 3-5 years from now, what are some of the things you're looking for to say, okay, this operator is conservative, he's considering whether interest rate is going to be in 3 to 5 years or whenever they were planning to exit?
I'll be honest, right now I feel very lost, right? I mean, how high are, right now we're in this weird spot, right, where you're going to get a 5% loan and cap rate 6%.
Right.
So I'll be honest, right now my crystal ball is very foggy. I'm still optimistic about the U.S. condition. Certainly very optimistic about Texas. Other parts of America may really suffer, but Texas in general, where I'm investing and doing things, is on fire. And so even if there is some sort of downturn or adjustment, we'll be sheltered from a lot of the impact of that. just purely because of what's happening, right? Texas is just, there's just such a supply and demand imbalance that a lot of bad things can happen and it'll still be okay.
Right.
But
Okay.
I'm definitely nervous. Obviously you want to see them, project the cap rate to be higher. You obviously want to see, hey, we're at this percent loan, and anybody who says 3 years from now we're going to be less than this percent, that worries me a lot, right? Because we just don't know, right? We
Right.
hope we're not going to be at 7-8% loans,
Mhm.
but we don't know. So my crystal ball is really foggy. So I'm actually kind of happy I'm not looking at deals right now as much, because it just
Right. Yeah. So now let's switch gear a little bit and talk about you're transitioning into doing more active side, right? You're now a GP. And so share with us your experience. What made you decide to get onto the GP side, and what are some of your experiences so far?
Yeah, so decided to get on the GP side purely because I was always planning to, and then losing my job accelerated it. And so, so I was definitely, it was something I planned to do. It just got accelerated, so I wasn't quite ready for it. And I was also came at it at a time when Texas was just so on fire, I couldn't win a deal. So to be honest, that's how I ended up in so many passive. I would sell some of my stocks, so I had hard money get a deal, and then I wouldn't even get close to getting the deal, and I'd be sitting on this cash, and all of a sudden a good investment from a friend of mine would come in my inbox, and I'll be, all right, I'll move that money over and I'll get some more money when I get a deal. So that's how I got kind of imbalanced. And then, right now, raising money is a little tough because people are nervous. People are unsure, so their crystal balls are foggy, just like mine is. So that's making them, less willing to just say, I'm in. It's taking a lot more hand holding, and, and I wouldn't consider myself a professional raiser yet by any scope of the imagination. I've got a long way to go to get there. I know I'll get there because I've been super active in connecting with people. I just gotta get that next link closed. But it's definitely interesting. And the first 2 deals I got on, I joined somebody else's deal. So it was really, they did all the work and I kind of came in the end, and I'm going to take a small asset management position because I'm closer to the asset, which is great because I'll get to learn, they own some assets already. So they've already got kind of a business plan in place. And so I'll get to learn a lot in theory, assisting people that have done it more than I have. And then my most current one, I am active part of it, so it was the first time I was doing due diligence for myself. I've done it at other people just to educate myself, but you pay a lot more attention when you're going to end up being the owner than when somebody else is going to end up being the owner. So, and then the amount of paperwork, goodness gracious. Man alive, and I hate paperwork. Man, there's a lot of paperwork. And, so a lot of people say, oh, these GPs, they got it easy. Man, it's hard work.
That's great. Okay, so yeah, so GP is definitely not for everybody, right?
Yeah, and you got to love what you're doing, right? And you got to be prepared to work. That's one thing that does worry me a lot about these mentor programs, right? They teach you how easy it is. You do it, you hire a property manager, and you sit on the beach drinking drinks and retire. It's not that. It is, and that's another thing, I'll be honest, that I've learned. I will not now invest in a deal that doesn't have an asset manager that's fairly close and it's their full-time job. Because I want somebody, when there's something going on in the property, that can give it 100% of their focus, right? Not try to answer the phone and do the work on their lunch break, or have to ask for an afternoon off from work to go do something to meet a contractor. I want to invest in people that have somebody full-time in market, dedicated to taking care of my investment. That was something I missed earlier, and it was something I missed earlier in some of my investments. I didn't push for it hard, but it's something I'm very aware that's super important, that this is somebody's full-time job. It's not they're not trying to do it and still do a 40-hour work week and do it on lunch break and weekends. You know, you
Right,
can't
right.
run a business on lunch break and weekends.
Gotcha.
At least on the active side, right? On the asset management side, you know, fundraisers or other, you know, but the people that are actually managing the asset.
Right. I understand. And so as a GP, what type of properties are you looking for? Are you sourcing right now?
Yeah, so I've sort of decided so I've been doing 48 doors and above and under 100. So 48 to stay out of the little guy's way and
Mhm.
under 100 to stay out of the big guy's way. You know, and I'm getting a little more activity in that niche, right? And
I see.
so, you know, because I want to stay away from the guys that are looking for their first, you know, 12 or 20 or 24 plex, and I'm trying to move on. But
Right.
it's, you know, so I've tried to stay in that little niche, and it's been, you know, I've been getting a lot closer on deals. And I think it's an okay niche because I'd still rather be 100 and above. But it's, you know, you just got to get a deal.
Right,
And
right.
you can still make it work.
Okay. So with all of your experience as an LP, it's interesting to me that you're having challenges to raise money. I figure by now you would know all of the, you know, objection handlers and like all the different ways you would you'd be able to explain to a passive investor, you know, why your deal makes sense, and you know, especially you as a professional passive investor, if it makes sense for you, you know, it should also make sense for the investors that you're raising money from. So
I too
share
am
with
surprised.
us.
I too am surprised. Now, part of it was I was building a network with people that are doing what I was doing, and that was a big mistake. And you know, when I left iFLY, most of the people were, you know, living paycheck to paycheck. There were no executives. So anybody looking to make this switch or looking to move on, you know, leverage your corporate connections before you leave. You know, build up your database with people that you know from work and you know from your other social things. You know, so I went from this little strange isolated world, and then I networked. And when I look at my database, everybody else on my database is also raising money for deals, right? They're not, and so I made the mistake not to focus on people that were passive investors and chase them. I chased other people hoping to do a deal with them. So it was a huge mistake on my part, and I'm working really hard to correct that now. And that's why I'm like on so many passive investor panels and trying to speak more about passive investing with people. You know, and I know I'll get it because I've laid a good foundation. I just gotta make the connections a little better.
Right, right. That makes a lot of sense for sure.
And better systems. Just to give you an idea how bad it was, the first time I raised money, I didn't have an active campaign or anything. So, and I'm not very techy, so I cut and paste 400 individual emails and sent them. Like I literally had a Word doc and I cut the copy over, I cut the subject line over, I copied the person's address, I wrote Dear Tim. It was ridiculously like inefficient, right? Because I hadn't set up a system. And now I'm building this system, and now I've started to build a funnel to reach out to people in different realms, more in the passive investor realm, and then have them come and then get on my database. So that was a hard lesson to learn, because I really thought, oh, I know everybody. This should be no problem. And I underestimated that, you know, I needed the amount of work that it took to get there.
Right, right. Yeah. So can you share on average how much you invested per deal of all the different?
Yeah, so it was very different. So several of the deals I actually went in for half of the minimum. It was because I wanted to invest in the deal, but I didn't have enough cash. So some of the deals I'm only in for 25,000 instead of 50, for example. So even though it sounds impressive, I'm not that wealthy. And the reason I were able to easily say yes to me, because I am an accredited investor. So for those that don't know, on a 506B, you're only limited to 35 sophisticated. So I didn't mess up their numbers, right? And they all said to me, you know, and again, I've had it where I've been raising money, and when unaccredited investors have done that, I've had to tell them, hey, listen, if we hit the 35 number, we're going to have to kick you out if somebody's going to be able to invest the minimum. So I've been fortunate to do that on a couple of deals. And some of it was just, you know, hey, I only got 28,000 in my IRA account. It took me a while to get to a 50. You know, are you willing to take 25? And so that's what happened a couple of times. Saying, hey, I want to be in the deal, but this is all I have.
Gotcha.
And then there's a couple of deals, you know, I've got 100,000 in, a couple 75, you know, average is 50 though. Most of the deals I'm in, I'm at the minimum of 50.
Gotcha. Okay. And then on the GP side, do you have a goal of how much money or how much asset under management that you're looking to acquire?
Yes. So $5,000 in 5 years.
Okay.
And you know, that's sort of my dream number, $5,000 in 5 years. And doors is a little bit fooling, you know, because, you know, you can have a lot of Class C doors and that's not much money. And you can have a lot of Class A doors, and $5,000 on Class A is a lot of money, you know. So I don't look at it, oh, I'm going to have 500 million or whatever. I just sort of did it doors.
Gotcha. Okay. That's great. And so for the listeners who are, you know, considering getting into passive investing, but haven't yet done one, and they're still a little fightful, or, you know, a little fearful. What advice do you have for them?
You know, so if you've decided that you want to do it, you need to just do it, right? You're going to be frozen with analysis paralysis. And I was a bit at the beginning, and then I just did it. And, you know, again, don't go off uneducated or do whatever, but you're going to just have to get out of this fear. You know, people somehow think when their money's in the stock market, they have some sort of level of control over it. They don't. When it's in their 401k, they don't. They have no control. Well, at least with this, you have the control to invest with who you want to give it to. You know, so it's a person, it's an asset. So I can research Tim and learn all there is to know about Tim. I can research his property, his market, his city. If I live in Texas and you're going to do a deal in Houston, I can drive there and look at it. I can look at your comps. Can I go look at Apple or Amazon? Yeah. The people don't get that they're actually, even though they're not in control, they've got a lot more control because they decide who. And then also external circumstances don't normally affect it, right? All of a sudden, the stock market crashes 10%. Well, those things are not necessarily happening in the real estate market, right? Real estate is appreciation over time. It's steady. Yes, we've had some crashes where people have done crazy things like the mortgage meltdown and stuff, but you know, put more protections in that. So, but people quite don't get the satisfaction of what they're getting.
Right. Okay. And would you recommend that they focus on one asset class, you know, and
so
get started in that before?
I definitely think you need to pick one. I've picked multifamily too, just to be example. So on my active, I picked multifamily. And the reason I picked multifamily is I know it, I understand it. And people always need a place to live. People don't always need a retail center. People don't always need a hotel. People don't always need a storage unit. And I picked that asset class too, because it's just such a high demand right now, right? There's like if you can't find a mini storage in your neighborhood, you buy a shed and put your junk in your own shed. You know what I mean? But if you gotta find a place to live, and you'd like to find a place to live near where you work. And so it's, you know, it's a very high demand thing. And it also comes with some of the best tax benefits. It comes with some of the best financing benefits. There are a lot of things that make multifamily, I'm going to call it the sweetheart of commercial investing. You know, there are just so many things about it that make it kind of the best way. Now, I have done other asset classes, and we didn't talk too much about it. And the reason I did it was just for a little bit of diversification, right? So I'm very Texas centric. I wanted to get at least a storage investment. I wanted to get something in the Carolinas. It's near Charlotte where my brother lives, so it's now a business trip to visit my brother. There's lots of factors why. So I wanted to get into storage. So all the stars kind of aligned. And so I decided to do it, and how much I'll learn about it. And am I excited about storing people's junk? No. Am I excited about making apartments better? And, my why is to have people say, come over to my home, not my apartment. If I could create a community that people said, come to my home, I died and gone to heaven, right? That's
awesome.
I want people to feel like their apartment is their home. I want the people to work there to feel empowered and like that they can create that environment. And then when you do those two things, investors make money and they can go do their whys. I can't say I want to have the best place for your junk. That's my why, right? It's just not a fulfilling why.
Right.
I understand that it makes money. I understand it's a great business. I understand it's very profitable. But it doesn't excite me that I'm making the world a better place, where buying an apartment, improving it. I did due diligence this week, and there's some people in there saying, their air conditioner has been fixed in a few months. And I hope to go there and fix their air conditioners and, give them a better place to live and care about where they live and, fix the deferred maintenance things that aren't there. And that walking that property after I do that, and having tenants feel like it's their home, it'll just be, there's big rewards in that. And I think even passive investors can feel like there's they're helping in a crisis in America, which is housing.
Right. So yeah, we're going to be wrapping up this interview here. I do have two more questions for you. One is if you can go back to your younger self, or if you can share, words of wisdom to a teenage kid, what would you share?
Yeah, it's easy. Don't wait to buy real estate, buy real estate and wait. If I had started this when I was in my 20s, life would be so much different. I mean, when I look back, I moved from Canada to America, and I was going to buy a place and do an Airbnb. And Airbnb was just kind of starting out. And, I said, man, $300,000 for this place. I don't know if I can afford it. The same place is worth $900,000 now.
Wow.
No, it's like, but I didn't, right? This is 25 years ago, and I didn't. And if I had of, my life would be that much different, right? Because now I would in theory own probably 3 Airbnbs or 5 Airbnbs in the area and be running this successful business and building wealth for my daughter who's still in Canada. And, just so, buy real estate and wait, don't wait to buy real estate. And so if you're young and you can just get started, try to find a single house or a duplex and house hack it, right? Go look at the Burr method on Bigger Pockets and just start grinding it out earlier, right? Rent rooms to your roommates, and then go from a single house to a duplex, to a quad, to a triplex, to a 6plex, to a 10plex. Just keep jumping that, and you'll be shocked. You'll be like, 45 years old and financially independent. I'm 60 something years old and barely financially independent because I started late. And if I'd have started early, life would, read books like Darren Hardy's The Compound Effect, right?
Love that book.
Just keep reinvesting, amazing book. Keep reinvesting your money. It's staggering what can happen when you get that compound effect of your money, right? And Warren Buffett always says, right, if you don't have a second way to make income, you'll work till the day you die. I should have memorized it, said it a little better, but it's a great quote.
Right. That's awesome. Love that. All right. So last but not least, if people want to reach out to you, connect with you, where should they go?
Yeah. So LinkedIn, I'm very active. So Trevor Thompson. Facebook, very active, Trevor Thompson. Sometimes you got to nudge me and say, you saw me on Tim's podcast, because I get a lot of friend invites and I'm careful because, I get a lot of people trying to sell me stuff. And if you've got Bitcoin anywhere in your thing, I'm not going to, because I don't want to, that's a crazy world. And then my website is Niagara, because I'm from Niagara Falls, -investments.com. And my email is my initials, KTT@NiagaraInvestments.com. And you'll find I'm very approachable. Reach out, set up a time to talk. I love to talk to people about real estate. It's I had no idea I'd be this passionate about it. It's a great way to end kind of my career in the world. And I didn't think I'd find something, but I love it.
I love it. And you loving real estate definitely show. I mean, your level of candidness and like just, raw to share your challenges on your deals and your generosity to open up. I really appreciate you. I thank you so much for doing this interview with me. I'm sure that the listeners gonna get great value out of this interview, and I definitely encourage the listeners to reach out to you, invest with you, do deals with you, at a minimum start building that relationship with you. So thank you so much, Trevor.
Real estate is a team sport. Go build a relationship with somebody.
Awesome. All right, thank you.